Question 1. Which of the following is a key benefit of using a captive insurance company for a business? A. Immediate reduction in premiums paid to external insurers. B. Simplified claims process with no regulatory oversight. C. Ability to tailor coverage to specific business risks. D. Elimination of financial audits and actuarial reviews. Answer: C. Ability to tailor coverage to specific business risks. Explanation: captive insurance companies are designed to allow businesses to tailor their coverage to their specific risks, which is one of their primary benefits. Unlike traditional insurers, captives provide flexibility in how risks are managed and covered. While captives can help reduce insurance premiums over time, they do not automatically result in an immediate premium reduction, eliminating option A. Furthermore, captives are still subject to regulatory oversight, including financial audits and actuarial reviews, which rules out options B and D. Question 2. Mr. Williams is the CFO of a large manufacturing company and is considering the formation of a captive insurance company. He is reviewing various options for structuring the company. What is a key consideration he must factor in when deciding between a single parent and a group captive? A. The tax implications of the captive's income from reinsurance. B. The level of risk diversification that can be achieved through pooling. C. The ability to invest the captive's reserves in high-risk securities. D. The requirement for a minimum number of directors in the captive's board. Answer: B. The level of risk diversification that can be achieved through pooling. Explanation: when deciding between a single parent and a group captive, a key consideration is risk diversification. A group captive, which involves multiple businesses pooling their resources, can achieve greater diversification of risk, thereby reducing the financial impact of large claims. In contrast, a single parent captive insures the risks of one company and is not able to pool its risks with others. Options A, C, and D are not as directly related to the decision between these two structures. Group captives are not specifically focused on tax advantages, option A, or high-risk investment strategies, option C, and while the number of directors on the board may vary, it is not the primary factor in choosing between captive types, option D. Question 3, scenario-based. Mr. Thompson, the owner of a medium-sized logistics company, is considering forming a captive insurance company to manage the company's growing workers' compensation claims. He has completed a feasibility study and is now preparing to submit his application for a New Hampshire captive insurance license. He is unsure whether he needs to comply with the state's capitalization requirements, as his company already has significant reserves. What should Mr. Thompson do to ensure his application is in compliance with New Hampshire's regulations? A. Submit the application without providing additional information, as his company's reserves are sufficient. B. Submit the application along with proof of sufficient reserves and demonstrate the ability to meet the state's minimum capital requirements. C. Apply for a waiver of the capitalization requirement due to the size of his business. D. Form a group captive instead of a single parent captive to reduce capitalization requirements. Answer: B. Submit the application along with proof of sufficient reserves and demonstrate the ability to meet the state's minimum capital requirements. Explanation: in New Hampshire, the formation of a captive insurance company requires compliance with specific capitalization requirements, even if the company has significant reserves. Mr. Thompson must submit proof of the company's ability to meet the minimum capital requirements set by the state's Department of Insurance, in addition to demonstrating the sufficiency of the company's reserves. This ensures that the captive will be able to operate effectively and meet its obligations to policyholders. Option A is incorrect because submitting an application without verifying capital adequacy would likely result in rejection. Option C is incorrect, as there are no typical provisions for waiving capitalization requirements solely due to the size of the business. Option D is also incorrect because the choice between a single parent or group captive does not reduce the capitalization requirements for a captive. Question 4. Which of the following is a typical responsibility of a captive insurance manager? A. Setting the premiums for all policyholders of the captive. B. Managing the underwriting, claims, and investment functions of the captive. C. Conducting actuarial reviews for external insurance policies. D. Establishing the regulatory tax rates for the captive's income. Answer: B. Managing the underwriting, claims, and investment functions of the captive. Explanation: a captive insurance manager typically oversees the operational aspects of the captive, including underwriting, claims management, and investment functions. They play a central role in ensuring that the captive operates efficiently, meeting its regulatory and financial obligations. Option A is incorrect because while the captive manager may play a role in pricing, setting premiums for policyholders is typically determined by the captive's underwriting committee. Option C is not correct because actuarial reviews for external policies are done by third-party actuaries, not the captive manager. Option D is incorrect as regulatory tax rates are established by state and federal authorities, not by the captive manager. Question 5. Which of the following best describes the primary purpose of a feasibility study when forming a captive insurance company? A. To determine the potential tax benefits of the captive insurance company. B. To analyze the financial and operational viability of the captive in relation to the company's risks. C. To decide on the most profitable investment strategies for the captive's reserve funds. D. To prepare a marketing strategy for selling the captive's insurance products. Answer B. To analyze the financial and operational viability of the captive in relation to the company's risks. Explanation. The primary purpose of a feasibility study is to assess the financial and operational viability of the captive insurance company in relation to the risks the company wants to insure. It helps to determine whether forming a captive is a sound business decision, considering factors like risk exposure, expected costs, and potential benefits. Option A is incorrect because while tax benefits are considered, the study's focus is on broader financial and operational factors. Option C is incorrect because the feasibility study is not primarily focused on investment strategies but on risk management. Option D is incorrect because a feasibility study focuses on internal financial factors, not marketing strategies. Question 6. Which of the following is true regarding the New Hampshire Department of Insurance's role in regulating captive insurance companies? A. It has the authority to issue and renew insurance licenses for captive insurance companies. B. It is only responsible for overseeing the pricing of policies issued by captive insurers. C. It directly sets the premiums charged by captive insurers. D. It manages the investment portfolio of each captive insurance company. Answer A. It has the authority to issue and renew insurance licenses for captive insurance companies. Explanation. The New Hampshire Department of Insurance is responsible for issuing and renewing insurance licenses for captive insurance companies, ensuring compliance with state laws and regulations. It does not set premiums, option C, or directly manage investments, option D. While the department does oversee compliance, it does not determine the pricing of policies, which is the responsibility of the captive insurance company itself, option B. Question 7. Scenario-based. Ms. Garcia is the risk manager for a multinational corporation and has been tasked with establishing a group captive insurance company for the company's various affiliates. She is working with several other companies within the same industry which are also interested in participating. One of the group members is concerned about potential high-risk claims impacting their finances. What risk management strategy should Ms. Garcia implement to address these concerns? A. Apply a comprehensive reinsurance program to cover large claims across all members of the group. B. Eliminate any high-risk members from the group to reduce potential claims exposure. C. Increase the minimum capital contribution required for all participants in the group. D. Use risk pooling to spread the claims exposure evenly across all members of the group. Answer A. Apply a comprehensive reinsurance program to cover large claims across all members of the group. Explanation. A comprehensive reinsurance program is a typical strategy used in group captives to manage high-risk claims. Reinsurance allows the group to cover larger claims that may exceed the captive's capacity, thereby protecting all members from potentially significant losses. Option B is not a viable solution because eliminating high-risk members could compromise the overall risk diversification of the group. Option C might increase capital but does not directly address the specific concern about large claims exposure. Option D involves risk pooling, but for high-risk concerns, reinsurance is a more effective solution to spread risk across a broader base. Question 8. What is the primary reason a company might choose to rent a captive insurance structure instead of forming its own captive? A. To avoid complying with the state's regulatory framework for captive insurers. B. To reduce upfront capital investment and operational complexity. C. To directly write policies for clients outside the company's corporate structure. D. To gain a higher level of control over its risk management operations. Answer B. To reduce upfront capital investment and operational complexity. Explanation. A rent-a-captive allows a company to access the benefits of captive insurance without the high capital investment and administrative burden of forming its own captive. This structure typically involves leasing space within an existing captive insurance company which handles most of the administrative and regulatory requirements. Option A is incorrect because even in a rent-a-captive arrangement, the company must still comply with relevant state regulations. Option C is incorrect because renter-captives are typically used for ensuring internal company risks, not writing policies for external clients. Option D is incorrect because a renter-captive provides less control than owning a standalone captive. Question 9. Which of the following is true regarding the taxation of small captive insurance companies under Section 831B of the Internal Revenue Code? A. They are exempt from state income taxes in New Hampshire. B. They are subject to federal tax on their gross income regardless of their profits. C. They can elect to be taxed only on underwriting income if they meet certain criteria. D. They must pay taxes on their reserve funds regardless of how much income is earned. Answer C. They can elect to be taxed only on underwriting income if they meet certain criteria. Explanation. Under Section 831B of the Internal Revenue Code, small captive insurance companies, those with gross premiums of $2.45 million or less, can elect to be taxed only on underwriting income rather than their gross income if they meet specific requirements. This tax treatment can offer significant tax advantages for qualifying captives. Option A is incorrect because the tax exemption does not apply to state income taxes in New Hampshire. Option B is incorrect because the tax is not on gross income but on underwriting income under the special tax election. Option D is incorrect as captives are not specifically taxed on reserve funds unless the funds generate taxable income. Question 10. Which of the following is the primary purpose of a captive insurance company's actuarial review? A. To determine the captive's eligibility for reinsurance coverage. B. To evaluate the adequacy of the captive's reserves for potential future claims. C. To assess the profitability of the captive's investment portfolio. D. To set the pricing for policies issued by the captive insurance company. Answer B. To evaluate the adequacy of the captive's reserves for potential future claims. Explanation. An actuarial review is primarily focused on evaluating the adequacy of the captive insurance company's reserves to cover potential future claims. Actuaries use statistical and actuarial methods to predict future claims and ensure the captive has sufficient reserves to pay for them. Option A is incorrect because while actuarial data may inform reinsurance decisions, the actuarial review is not focused on determining reinsurance eligibility. Option C is incorrect because the actuarial review focuses on liabilities, not the investment portfolio. Option D is incorrect as pricing is typically handled by underwriting, not actuaries. Question 11. Which of the following is typically a benefit for a company choosing to establish a captive insurance company? A. Enhanced control over risk management and insurance costs. B. Guaranteed profit from underwriting operations. C. Automatic exemption from state insurance regulations. D. Direct access to government-backed reinsurance programs. Answer A. Enhanced control over risk management and insurance costs. Explanation. One of the primary benefits of establishing a captive insurance company is the enhanced control it gives the parent company over its risk management and insurance costs. By owning and operating the insurance company, the company can tailor coverage to its specific needs and manage its premiums more effectively. Option B is incorrect because while captives can be profitable, they do not guarantee profits. Option C is incorrect because captives must still comply with state insurance regulations. Option D is incorrect as captives do not have automatic access to government-backed reinsurance. Question 12. Which of the following describes a protected cell in the context of a captive insurance company? A. A separate legal entity within a captive that writes policies for external clients. B. A division within the captive that shields the assets of individual participants from liabilities. C. A specific fund set aside for paying claims under an individual participant's policy. D. A reinsurance company used exclusively by captives to cover large claims. Answer B. A division within the captive that shields the assets of individual participants from liabilities. Explanation. A protected cells structure within a captive insurance company that allows for separate accounting and liability protection for different participants, effectively shielding their assets from the liabilities of other cells. Option A is incorrect because a protected cell is not a separate legal entity but a part of the captive. Option C is incorrect because it refers to a reserve fund, not a protected cell. Option D is incorrect because a reinsurance company is not a protected cell. Question 13. Which of the following best describes the role of an independent auditor in a captive insurance company? A. To manage the captive's investment portfolio. B. To evaluate the actuarial assumptions used in setting premiums. C. To provide an objective assessment of the financial health and operations of the captive. D. To determine the appropriateness of the captive's insurance policies. Answer C. To provide an objective assessment of the financial health and operations of the captive. Explanation: an independent auditor's primary role is to provide an objective and thorough review of the financial statements and operations of the captive insurance company. This includes verifying the accuracy of financial records and assessing the company's compliance with applicable regulations. Option A is incorrect because managing the investment portfolio is typically the responsibility of the investment manager, not the auditor. Option B is incorrect because the actuary is responsible for evaluating the actuarial assumptions. Option D is incorrect because policy decisions are made by the captive's management, not the auditor. Question 14, scenario-based. The ABC Corporation has set up a captive insurance company to cover the company's property and liability risks. However, the company is facing challenges in managing large, unexpected claims that exceed the captive's capacity. Which of the following actions should the company take to address this situation? A. Increase the deductible for all policies to reduce claim frequency. B. Purchase excessive loss reinsurance to cover claims that exceed a specified threshold. C. Reduce the number of policies issued by the captive to lower exposure. D. Implement stricter underwriting criteria to limit risk exposure. Answer B. Purchase excessive loss reinsurance to cover claims that exceed a specified threshold. Explanation: excessive loss reinsurance is designed to protect the captive from large unexpected claims that exceed a certain threshold. This would allow the captive to manage its risks more effectively while still maintaining coverage for significant losses. Option A is incorrect because increasing deductibles would not address the issue of large claims, but rather shift more risk to the insured. Option C is incorrect because reducing the number of policies would not solve the issue of large claims. Option D may help control risk, but it does not address the problem of managing large claims. Question 15. Which of the following is true regarding the capitalization of a captive insurance company? A. The required capitalization amount is set by the insurance company's reinsurer. B. Captives must maintain a minimum capital amount defined by the insurance department of their domicile state. C. The capital requirement is solely determined by the parent company based on its own risk appetite. D. There is no capital requirement for captives if they are registered under a risk retention group. Answer B. Captives must maintain a minimum capital amount defined by the insurance department of their domicile state. Explanation: captive insurance companies are required to maintain a minimum capital amount as defined by the insurance department of the state or jurisdiction where they are domiciled. This ensures that the captive has sufficient resources to cover its liabilities. Option A is incorrect because the reinsurer does not set the capital requirement. Option C is incorrect because the capital requirement is regulated by the domicile state, not solely by the parent company. Option D is incorrect as risk retention groups also have capital requirements, though they may be different from other captives. Question 16. A captive insurance company is created with the primary goal of providing coverage to a group of related companies. What type of captive insurance company is most likely being formed? A. A single parent captive. B. A group captive. C. A renter captive. D. A reinsurance captive. Answer B. A group captive. Explanation: a group captive is formed when multiple unrelated companies come together to share the risks of insurance coverage. This type of captive allows them to pool resources and gain benefits from shared risk management. Option A is incorrect because a single parent captive is owned by a single company, not a group. Option C is incorrect because a renter captive is a captive that companies lease from a third-party provider. Option D is incorrect because a reinsurance captive primarily provides reinsurance coverage, not direct insurance for a group of companies. Question 17. Which of the following is a common reason why a company might choose to domicile its captive insurance company in Bermuda? A. Bermuda offers a tax-exempt status for all captive insurance companies. B. Bermuda has a strong regulatory environment that supports captive insurance operations. C. Bermuda has strict investment restrictions that limit risk exposure for captives. D. Bermuda provides automatic coverage for natural disaster risks. Answer B. Bermuda has a strong regulatory environment that supports captive insurance operations. Explanation: Bermuda is known for having a favorable regulatory environment for captive insurance companies, which includes flexible and efficient regulatory processes that make it an attractive domicile for captives. Option A is incorrect because while Bermuda offers favorable tax treatment, it does not provide a blanket tax exemption for all captives. Option C is incorrect as Bermuda's regulatory environment allows for a broader range of investment options. Option D is incorrect because Bermuda does not provide automatic coverage for natural disasters and captives must manage their own risk exposures. Question 18 scenario-based. A large manufacturing company decides to form a captive insurance company to cover its property damage risks. The company is concerned about the potential volatility of its claims costs. To stabilize its cash flow, the company opts to implement a funding mechanism. What would be the most appropriate funding option for the company? A high deductible plan to reduce upfront premiums. B, a fronting arrangement with a third-party insurer. C, a loss portfolio transfer to cover past claims. D, a premium payment plan that allows for flexible premium payments over time. Answer: D, a premium payment plan that allows for flexible premium payments over time. Explanation: a premium payment plan that allows for flexible premium payments is an effective way to stabilize cash flow by spreading premium payments over time. This method helps manage the volatility of claims costs and cash flow. Option A is incorrect because a high deductible plan does not address cash flow stability. It shifts more risk to the insured. Option B is incorrect because a fronting arrangement involves using a third-party insurer to provide the necessary legal framework for the captive, not directly managing cash flow. Option C is incorrect because a loss portfolio transfer involves covering past claims, which does not address future claims volatility. Question 19. What does self-insurance refer to in the context of captive insurance? A, the practice of using a third-party insurer to manage the company's risk exposures. B, the practice of a company assuming its own risk and paying for losses out of its own funds. C, the purchase of stop-loss insurance to protect against catastrophic losses. D, the use of a commercial insurance policy to cover risks within the company. Answer: B, the practice of a company assuming its own risk and paying for losses out of its own funds. Explanation: self-insurance involves a company assuming responsibility for its own risk rather than purchasing insurance coverage from a third-party insurer. This typically involves setting aside funds to cover future claims. Option A is incorrect because third-party insurers are not involved in self-insurance. Option C is incorrect because stop-loss insurance is a separate coverage, not part of self-insurance. Option D is incorrect because purchasing a commercial insurance policy is not considered self-insurance. Question 20. What does the admitted assets requirement refer to in a captive insurance company? A, the requirement to invest in assets that are recognized and accepted by the regulatory authority for solvency purposes. B, the assets that are owned by the captive company but are not included in the financial statements. C, the requirement to hold a minimum amount of assets to pay for any claims that may arise. D, the assets that can be sold or liquidated to meet premium obligations. Answer: A, the requirement to invest in assets that are recognized and accepted by the regulatory authority for solvency purposes. Explanation: admitted assets are those assets that are recognized by the regulatory authorities, such as state insurance departments, and are included in the financial statements of the captive. These assets must meet the regulatory standards for solvency, meaning they must be liquid and easily convertible into cash if needed to cover liabilities. Option B is incorrect because admitted assets must be part of the financial statements. Option C is incorrect as the minimum required assets are generally related to regulatory solvency standards, not just claims payments. Option D is incorrect because admitted assets refers to accepted financial assets, not assets that must be liquidated to meet obligations. Question 21. Which of the following is a key benefit of forming a captive insurance company for a business? A, low premiums compared to traditional insurance markets. B, ability to transfer risk to other insurance companies. C, increased regulatory oversight and scrutiny. D, the ability to use captive insurance as a means of enhancing corporate governance. Answer: A, low premiums compared to traditional insurance markets. Explanation: one of the primary benefits of forming a captive insurance company is the potential for reduced insurance premiums. By insuring their own risks, businesses can retain control over the premiums they pay, avoiding the administrative costs and profit margins of traditional insurers. Option B is incorrect because captive insurance companies retain risk rather than transferring it to others. Option C is incorrect as captives typically face less oversight compared to traditional insurance. Option D is incorrect because corporate governance, while important, is not the primary benefit for businesses forming captives. Question 22. A captive insurance company must provide annual financial statements to the New Hampshire Department of Insurance. Which of the following is generally not included in these statements? A. Balance sheet. B. Income statement. C. Underwriting profit loss statement. D. Actuarial report. Answer C. Underwriting profit loss statement. Explanation. While a captive insurance company is required to submit an annual balance sheet, income statement, and actuarial report to the New Hampshire Department of Insurance, the underwriting profit loss statement is typically not required as a standalone document. The income statement provides the overall financial performance, including underwriting results, but this specific breakdown is not a requirement. Option A, B, and D are all required documents for the annual reporting process. Question 23. What is a rent-a-captive structure in the context of captive insurance? A. A type of insurance product provided by captives to other businesses. B. A business structure where a company rents space within an existing captive insurance company. C. A captive insurance company that exclusively insures rental properties. D. A temporary arrangement where companies rent their capital to a captive insurance company. Answer B. A business structure where a company rents space within an existing captive insurance company. Explanation. In a rent-a-captive arrangement, the company rents the use of an established captive insurance company's infrastructure and management. This structure allows businesses to take advantage of the benefits of captive insurance without having to create and manage their own captive. Option A is incorrect as rent-a-captive is not about selling products to others. Option C is incorrect because rent-a-captive is unrelated to rental properties. Option D is incorrect because it refers to a rental of capital rather than the use of a captive's infrastructure. Question 24. Which of the following is an important consideration for a business when selecting a jurisdiction for its captive insurance company? A. The cost of incorporation and annual fees in that jurisdiction. B. The local political climate and tax rates. C. The ease of access to global markets for reinsurers. D. All of the above. Answer D. All of the above. Explanation. When selecting a jurisdiction for a captive insurance company, several factors must be considered, including the cost of incorporation and annual fees, the local political and tax environment, and the access to global reinsurers. These elements can significantly impact the captive's operations, costs, and profitability. Each of these factors plays a role in the decision-making process. Therefore, D is the correct answer. Question 25. In New Hampshire, what is the minimum amount of capital required to establish a captive insurance company? A. $500,000. B. $1 million. C. $2 million. D. $3 million. Answer B. $1 million. Explanation. In New Hampshire, the minimum capital requirement for establishing a captive insurance company is typically $1 million. This ensures that the company has sufficient financial resources to cover liabilities and operate effectively. Options A, C, and D are incorrect as they do not reflect the required minimum capital for formation. Question 26. Scenario-based. John is the CFO of a mid-sized manufacturing company. He is considering forming a captive insurance company to handle the company's growing liability risks. Before proceeding, he hires an actuary to assess the feasibility of the captive insurance. The actuary performs an analysis of the company's risk exposure and recommends setting aside a certain amount of reserves for claims. What is the purpose of this actuarial analysis? A. To determine the appropriate amount of capital required to form the captive. B. To calculate the reserve amounts needed to cover potential future claims. C. To establish the rates at which the company will sell its insurance policies. D. To provide a legal opinion on the company's compliance with New Hampshire law. Answer B. To calculate the reserve amounts needed to cover potential future claims. Explanation. An actuary's role in captive insurance is to assess the risk exposure and calculate the amount of reserves necessary to cover potential claims in the future. This analysis helps the captive maintain sufficient funds to meet future liabilities. Option A is incorrect as determining capital requirements is part of the formation process, not the actuary's main role. Option C is incorrect because rate setting involves underwriting, not actuarial analysis. Option D is incorrect because while actuaries may be involved in compliance issues, their primary function is risk analysis and reserve calculation. Question 27. Which of the following is an example of a risk management strategy commonly used by captive insurance companies? A. Increasing insurance premiums for all policyholders. B. Implementing safety protocols to reduce claims exposure. C. Transferring all risk to a third-party reinsurer. D. Reducing coverage for high-risk areas to lower costs. Answer B. Implementing safety protocols to reduce claims exposure. Explanation: captive insurance companies often focus on risk management strategies that reduce the likelihood of claims, such as implementing safety protocols and loss prevention programs. This proactive approach helps minimize potential payouts and strengthens the financial position of the captive. Option A is incorrect because increasing premiums is not a risk management strategy but a pricing strategy. Option C is incorrect as captives typically retain risk, though they may use reinsurance to manage excess risk. Option D is incorrect as reducing coverage may expose the company to greater liabilities in the event of a claim. Question 20. Which of the following is required by New Hampshire law for a captive insurance company in terms of reporting? A. Annual actuarial reports signed by a licensed actuary. B. Quarterly profit and loss statements filed with the Department of Insurance. C. Detailed claims history reports for the previous 10 years. D. A list of all policyholders, including personal information. Answer A. Annual actuarial reports signed by a licensed actuary. Explanation: New Hampshire law requires that captive insurance companies submit an annual actuarial report signed by a licensed actuary to assess the adequacy of reserves and pricing. Option B is incorrect because quarterly financial reports are generally not a requirement for captives in New Hampshire. Option C is incorrect because claims history is not typically required for annual filing, although it may be reviewed for specific audits. Option D is incorrect as New Hampshire law does not require captives to submit personal information about policyholders in public filings. Question 29. What is the purpose of reinsurance in the context of a captive insurance company? A. To increase the overall risk retention of the captive. B. To transfer risk to another insurer in exchange for a premium. C. To provide a mechanism for issuing bonds in the market. D. To reduce the capitalization requirements of the captive. Answer B. To transfer risk to another insurer in exchange for a premium. Explanation: Reinsurance is a practice where a captive insurance company transfers a portion of its risk to another insurer, known as the reinsurer, in exchange for a premium. This allows the captive to manage large or catastrophic risks that it may not be able to retain. Option A is incorrect as reinsurance helps reduce risk retention, not increase it. Option C is incorrect because reinsurance does not involve issuing bonds. Option D is incorrect because reinsurance does not directly affect capitalization requirements. Question 30. What is the role of the New Hampshire Department of Insurance in the regulation of captive insurance companies? A. To manage the operations and investments of captive insurance companies. B. To ensure compliance with financial reporting, solvency, and operational regulations. C. To provide captive insurance products to businesses. D. To guarantee payment of claims from captives. Answer B. To ensure compliance with financial reporting, solvency, and operational regulations. Explanation: The New Hampshire Department of Insurance oversees captive insurance companies to ensure they comply with all applicable financial, solvency, and operational regulations. This includes reviewing annual financial statements, actuarial reports, and ensuring that captives meet regulatory capital requirements. Option A is incorrect as the department does not manage the operations of captives. Option C is incorrect because the department does not provide insurance products. Option D is incorrect as the department does not guarantee claims payment.